Hello and welcome to this lecture on securitization. I hope you're doing well from wherever it is you're joining us. In this class, we will introduce the idea of securitization. This is an important financial innovation that gained prominence in the 1970s. We will see how important securitization is for the US economy. Last, we will see how securitization depends on short-term funding markets. Let's first have a look at how securitization works. We will understand the process and also why it is profitable. The process is worth understanding, so I can recommend watching this part a couple of times. Consider one mortgage loan to one customer. Based on the customer's risk profile, suppose we expect the customer to default with a probability of 2%. With only one loan and one customer, you face one of two outcomes. The borrower either repays the loan or defaults. The losses of these loans are highly uncertain. It's all or nothing. Now consider a pool of 100 of these mortgages. Let's again assume that each customer has a probability of default of 2%. Let's assume these borrowers all live in different parts of the country. This means that they are unlikely to all default at the same time. So, what is the risk of default in this pool of 100 loans? You expect 2 out of 100 to not repay. In reality, with 100 loans, you may find that 1 does not repay or 3 do not repay. But what is important here is that it isn't all or nothing. With 100 mortgages, there's less uncertainty than in the one loan example. Now consider a pool with 10,000 of these mortgages. With a probability of 2% of default, you expect 200 defaults. This time your expectation is likely to be fairly accurate. There may be 190 or 210 defaults, but this is 1.9 or 2.1%. This is very close to your expectation. What is the key takeaway? We want a large, well-diversified pool of mortgages. Then we can accurately estimate the cash flow. These are the losses and repayments on the loans. Being able to precisely forecast cash flow of pools of loans makes securitization work. Now let's introduce the second piece of the puzzle. In a securitization, an issuer sells securities backed by the loan pool. These usually consist of bonds and equity. These securities are used to fund the mortgages. With a good estimate of the cash flow, we can issue a significant amount of bonds. The coupon payments on these bonds come from the mortgage interest payments from the pool. The securities are designed so that the bondholders get paid first. These bonds have the first claim on the cash flow generated by the loan pool. This makes the bonds relatively safe. The equity securities also receive cash flow from the mortgage pool. However, they are paid second. The owners of the equity portion get the remaining cash flow after all bondholders have been paid. Why is securitization profitable? Let's look at a concrete example. Suppose you have a pool of mortgages worth 100. Let's say these mortgages pay 5% interest. We issued $80 of bonds and keep the $20 of equity for ourselves. These $100 of securities fund $100 of mortgages. Since the bondholders get paid first, they are relatively safe. Let's say we promise 4% interest on the bonds. Then we get paid whatever is left over at the end.
So, if no mortgages default, then the pool generates $5 of cash. The $80 of bonds get a 4% return, so that's $3.20. The equity holders get the remaining $1.80. If 2% of the mortgages default, then the pool generates $4.90. The bondholders are fine since they have priority, so the equity holders get 10 cents less.
With unexpectedly high defaults, the equity holders could get nothing. The equity holders usually make a nicer return on their investment. However, they also bear the risk. This example illustrates the basics of securitization. It is arguably the most important financial innovation of the 20th century. It also shows how securitization works as a funding model. With a precise estimate of the cash flow in the securitization pool, you can use bonds to fund the loans. The lender does not need to have the cash to grant all of the loans. Instead, they can borrow it from the market. Since the 1970s, the possibility to raise funding for loans on the securitization market has increased the supply of credit to firms and households in the United States. Let's look at some data on securitization in the United States. In the US, a large amount of loans to households and businesses are securitized. This has increased dramatically since the 1980s. There was a large drop-off after the 2008 financial crisis. Despite this, by 2021, the total amount of bonds that were related to securitization was about $12 trillion. Most of these bonds, more than $10 trillion, were issued by government-sponsored enterprises and guaranteed by the US government. These bonds are considered to be as safe as US Treasury securities. The rest came from securitization of private issuers such as banks and finance companies. The vast majority of securitized loans are mortgages. These include residential mortgages for your single-family home. We can also see mortgages for multifamily homes and apartment buildings, commercial mortgages for office buildings or shopping malls. The other loan category includes auto loans and small business loans. One final point before we wrap up. Securitization can be sensitive to conditions in short-term funding markets. Why is this the case? Well, many issuers finance loans on a short-term basis before they can be pooled and securitized. For example, they raise cash by selling commercial paper to money market mutual funds. Then, they use the cash to grant loans. Once they have granted enough loans, they securitize the pool, and then the issuer repays the commercial paper with the funds raised from bond investors. This is one reason why disruptions in short-term funding markets can affect the wider economy. When short-term funding dries up, the securitization model breaks down. When this happens, such as during the 2008 financial crisis, firms and households can struggle to access credit. What have we learned in this session? First, securitization is an important funding model that emerged in the 20th century. It is based on statistical models relying on a large number of loans to reduce uncertainty. It involves pooling loans and issuing securities that are backed by the loan pool. Second, we saw how the securitization funding model has increased the total supply of credit in the United States. Third, there are potential downsides. We discussed how securitization can be sensitive to conditions in short-term funding markets.